You're watching us here on Midcap Radar. I'm Manglam Malu. With me as always, Vivek. It's a wonderful afternoon and the screen that we're staring at tells you 23,100 on the Nifty thereabouts and very close to 50,000 now for the Nifty Bank itself. Just about 350 points away. Vivek, does that happen today or does that happen this week?
Hopefully sooner rather than later. Like you just saw on the top of your screen, it's green across, and all of the banking stocks have made a spectacular comeback up. All of the names, especially the mid-cap banks, all of them that were taken quite a bit of a beating in the last couple of weeks, today they are back. But it's an action-packed show that we have for our viewers, and let's start with the top headlines. Market scale fresh peak, Sensex tops 76,000 for the first time, led by gains in the banks and financial space. Mid-caps fare better.
Divis gains after beating estimates on growth and margin. Torrent Pharma perks up on positive guidance, while Glenmark Pharma peps after it projects healthy growth ahead.
Ashok Leyland hits a fresh 52-week high after brokerages raised target price post the Q4 earnings. Management guides for a mid-teens EBITDA margin growth over the near term.
DOMS Industries surges after the revenue from operations and EBITDA surges on a year-on-year basis. Management says they continue to see positive business traction.
Sun TV slips after reporting a weak Q4 numbers. EBITDA margin declined over 510 basis points due to rise in operating expenses and cricket franchise fees.
All right, so those were all the top stories that we were tracking at this hour. A bunch of mid-caps doing actually quite well, and these are the ex-pharmaceutical stocks that we're talking about right now. REC has begun to rally once again, had a decent move on Friday and, a couple of trading sessions before that as well. Before, it saw a bit of a dip earlier after a big rally that he had seen earlier. So it's resumed that up move that we're seeing. Granules from the pharmaceuticals pack, while that continues to do well. Vivek did speak about a bunch of these rather mid-cap banks doing well. So Federal Bank is the one that should come up for you that, was under a wee bit of pressure, but now that's recovered and has moved to the high point of trade, giving it company are names like Godrej Properties. Saw a bit of a decline on Friday. Maybe some, worries around one of its projects in Mumbai. But there has been no official word coming on there. So maybe a bit of short covering is what we're seeing on Godrej Properties. Decent up move is what we've seen on Jubilant Foodworks as well. Perhaps a lot of pizzas being ordered on account of the IPL finals.
You're absolutely right. You mentioned Federal Bank. A couple of other banking names. Have a look at Bandhan Bank. Have a look at names like AU Small Finance Bank. These stocks too today have bounded off, opening in the green, but has seen continued buying interest through the trading session. But a whole host of other stocks, and I'm sure Hormaz has a lot more in his list. This is our special segment, Mid-Cap Movers. Hormaz, take us through the list.
The mid-caps are doing well and REC is doing well, so it's a good day for the market as far as the mid-cap stocks are concerned. We'll start off with some of the other gainers besides what the guys highlighted just now. And Phenolics Cables is the one that continues to surge higher now. Another record high, 8% higher today as well after the up move that we saw on Friday. JBM Auto is the other gainer on the small cap index, is 6.5% higher there. Paytm is a surprise inclusion in the green in today's session. Persistent Systems is the top mid-cap IT gainer today, 6.5% higher today. And Jubilant Foods is having a good day as well, a bit of a rebound after some sell-off on Friday. Plenty of earnings reactions that are coming in thick and fast. The last leg of the earnings season, Ashok Leyland 6% higher now, 223 on the stock. Glenmark Pharma is the top F&O gainer now, 7% higher for Glenmark after some very positive management commentary. Affle India and Exide also having a good day after their results. PSU banks are the ones that are doing well. The top sectoral gainer is the PSU banking index, and Indian Overseas Bank, UCO Bank, all of these stocks seeing gains of anywhere between 4 to 9%. Of course, very little float in the market, so we need to exercise that bit of caution. Some stocks doing well on the back of volumes, and they'll come up on your screen now. Then AstraZeneca Pharma off the day's high, but still 5.5% higher on very strong volumes. Aegis Logistics and RCF fertilizer stocks are been having a good couple of days actually, and RCF is one of them, 5% higher. And lastly, some stocks that are bucking the trend in today's trading session. EIH is down 5%. Schneider Electric, a second consecutive lower circuit there in today's session, and Data Patterns and Sun TV, another earnings reaction at the lowest point of the day now, down 4%. Back to you guys.
Take that point, Hormaz. Thank you for joining in and giving us a list of stocks which are gaining both on the upside and the ones which are losing on the downside as well. What's interesting is that if you pull up, the chart of the advanced decline, you would see that even as the mid-cap index is up around 1.5%, you have more stocks which are declining than the number of stocks which are advancing. So for the last 3 trading sessions, it's not been a runaway rally on the number of stocks which are gaining versus the number of stocks which are declining. It's actually been at a largely even keel over the last 3 trading sessions itself. Some numbers at the bottom of your screen. HBL Power, a big jump in the net profits. In fact, 81 crores versus 35 crores. Revenues up around 51% as well. So looks like an all-round beat. A beat on the top line has percolated on the bottom line, and understandably the stock has seen a rally of 5% as well. Perhaps for all these moves, with the kind of mode of the market, one would see that it's moving further higher as we move towards close of trade. But let's get in Ashish Kyal of Wave Strategy Advisors for a quick technical check on the market. Ashish, seems like the Nifty bank has started a fresh new up move. What are the Elliott Waves saying?
See, the overall trend for Nifty and Bank Nifty, both the indices is positive. And if you look at Bank Nifty especially, we can clearly see a very smart rally on the upside over the past 2 or 3 trading sessions. And it is yet to touch that lifetime high levels even when Nifty is touching it. So the overall wave pattern is suggesting that we might be heading towards on the upside towards 50,500 levels on Bank Nifty overall. And on the downside, the support for the index is around 49,100. So as long as 49,100, which is the gap area created today, is intact, I think Bank Nifty should be heading towards 50,500 lifetime high levels. We should be able to see that. And on Nifty is concerned, I think the overall trend is positive. Any dips on Nifty should be used as buying opportunity. 23,000, there were call writers who are trying to now cover their positions. If we manage to sustain at these levels, we can head towards the level of 23,150 on upside on Nifty over intraday, and possibly eventually we should head towards 23,290 on Nifty as well. So the overall tone remains bullish. Use any dips as a buying opportunity.
Good afternoon, Ashish. Welcome to the show. So any individual stocks that you have on our radar? What is it that you like at current levels?
If you look at Dabur has given a very strong breakout in today's session. The volumes have also picked up, and it has formed a higher high, higher low formation, possibly a third wave on the upside that is starting on Dabur. So one can create long positions here, expecting a target of around 610 on the upside. And on the downside, the stop loss can be maintained at around 550 levels. And the next stock on the buy side is going to be JSW Infra. We can clearly see the stock had been consolidating over past 2 or 3 trading sessions and can give a very strong breakout on the upside over here. And one can expect a target of around 305 and maintain a stop loss of 275 for this stock.
Thank you so much, Ashish, for joining us here at Midcap Radar. Let's now slip into a short break. When we return, we will be joined by Jose Jacob, the Chairman and Managing Director of Antony Waste Handling Cell, to discuss the quarter gone by. Stay tuned. Welcome back to Midcap Radar. We have a corporate on our show, and it's a very interesting corporate. Antony Waste Handling Cell is in focus on the back of its Q4 numbers. Net profit has more than doubled on a year-on-year basis, and EBITDA margins too expand. Jose Jacob, the Chairman and Managing Director of the company, joins us now to discuss further. Good afternoon, Mr. Jacob. First up, how would you rate Q4? There's been a very sharp jump as far as profitability is concerned. So can you sustain this momentum going forward? FY25, what is the guidance that you've given to the street in terms of revenue, margins, as well as bottom line?
So historically, our CAGR growth has been 20 to 25%, and we have been achieving that. And we believe that we'll carry forward the same performance.
When you say... All right, Jose. You said that, 20 to 25%. When you say 20 to 25%, what is it that you're meaning? Because the revenues that I look at is... Yeah, go ahead.
I would say it's that 20 to 25% in 3 to 4 years. In our style of businesses, when we win a contract, it takes about 18 months to full-fledged start it. And that's the reason we look at, and our contracts are long-term contracts. The period is 7 to 25 years. So we take a CAGR growth of 20 to 25% in every 3 to 4 years or maybe 5 years.
Okay, because, I'm looking at the last 1 year, your revenues have grown just around 2.2%. Operating profit too has not grown much. Margins have improved from 17% to 20%, but they've been 25 to 28% in the past as well. And, the net profit, while it has grown, it's factors other than, operations that have led to the net profit growth in the fourth quarter. So, to that extent, what is a realistic target on revenue, margins, and profitability for the next year?
So, our operating profit, our operating revenue was 766 crores, which is a 19% increase compared to the last year. Last year it was 643. And the EBITDA margin, if you see QFI 2023, we have increased from 153 to 198 crores. So there has been quite a good improvement, impressive performance on the EBITDA side.
So despite this, despite the kind of performance that you've seen in FY24, you're actually factoring in a much higher number as far as FY25, 6 and 7 is concerned, because you're giving us a 3-year CAGR. It's a two-part question. Would you like to give a specific margin as well as a PAT guidance? And number two, recently you had analysts over to your WTE plant at Moshi in Maharashtra, and you've given them a guidance of annual projected revenues from that particular facility at close to 65 crore. So where are we on that front?
So there are one is the waste to energy project in Moshi, which will have a 1 full year full-fledged revenue from there. And another business which we had, one is construction debris, which will also start generating revenue from the month of June. And third is the biomining contract, which we have won, and for CIDCO, which also the revenue will start from this June. And when you add all these three, that definitely we look forward our revenue as well as our EBITDA margin will be good.
Okay, so what will be the revenue that will come in from the refuse derived fuel, that is biomining, and what is the potential of revenue coming in from the CIDCO contract?
CIDCO contract will be roughly, I think this coming year, we should have at least 40 odd crores. And construction debris, we will get around 35 to 40 crores. And
the biomining thing is a part of the construction debris, or is that separate?
No, it's separate contract.
So how much will that give?
That will give around roughly 40 crores.
Okay, so 40 crores from biomining, 35 crores coming in from construction debris, and another 40 crores coming in from CIDCO.
Yes, construction debris, yes.
Mr. Jacob, let's now move to another stream of revenue for you, which is the vehicle scrappage business. You said that the TAM, or the total addressable market for you, is close to 8,000 crore over here. What is the total cost that you will bear in order to go up and set up a facility for this particular project? Along with that, what is the kind of revenue stream you're penciling in as far as FY25 is concerned, and what projects do you already have in place?
So we are looking to venture into vehicle scrapping business as well as tire recycling, and for which we are discussing with various equipment suppliers. And roughly the capital cost for such plant is around 10 to 15 crores in that range for scrapping, vehicle scrapping, and for tire will be around 5 crores. So we already have found a land, and we are working on all the statutory requirements when it comes to pollution control board and getting licenses from the government.
More than 40% of your revenue comes in from MMR. Just wanted to know how much of that comes in from BMC, because the BMC elections haven't happened for the last couple of years. So once that happens, wanted to know if there is any sort of political risk that comes by with the contracts that you have.
No, our contracts are long-term contracts. It was signed, the waste processing was signed somewhere in 2009, and the collection transportation was signed somewhere in 2016 or something like that. So it's a long-term contract, and for us, we do not have, being a waste management company, which is a very important work to be done in the city, we don't face any political risk.
So when do these contracts come up for renewal, just before we let you go?
The one in, no, the waste processing will end in 2037, and collection transportation maybe another 2 years left.
Mr. Jacob, thank you so much, for your time over here. Thank you for the clarifications, especially towards the end. But that's the time we have, with you today. We'll hold you to these numbers, in the coming quarters as well. But right now, let's slip into a short break. We'll put focus on ITC as proxy advisory firm IIAS asked shareholders to vote against the demerger. Stay tuned.
Well, this is mid-cap radar. Typically, we speak about mid-caps, but today ITC is the stock on our radar, and that's because if you just take a look at the intraday chart, the stock is closer to the lower end of today's trading session. This afternoon, we got a report that came in from IIAS, which is a proxy advisory firm, and in its report, it said that it's advised the shareholders to vote against the company's proposed resolution to demerge the hotel business. Remember, the ITC shareholder meet is on June 6th to consider the hotel demerger. The key rationale for that is because despite the demerger, ITC will continue to hold 40% stake in the hotel business. So this transaction does not provide a complete exit from the hotels business for the ITC shareholders. Additionally, ITC will have to, as promoter, continue to provide capital support to the hotel business. And at the same time, the board has not clearly articulated its plan for 40% holding in the hotels business. IIAS also says ITC must provide clarity on the synergies it expects to by maintaining this 40% equity in hotels, and there is no clarity further on the terms of the brand usage fees between ITC and hotel business as well. Now, this is an important piece of news that is coming from IIAS, and also, a lot of proxy firms will be putting their views forth ahead of this shareholder meet, and one such is InGovern too. So we have Sriram Subramaniam, who's the founder and MD of InGovern Research, joining in. Sriram, first up, if you could explain your position on the same and the rationale that backs it?
Yeah, thank you for having me on the show. See, we have recommended that shareholders vote for the demerger. Effectively, when this demerger was announced last year, already shareholders were asking for unraveling of some of the businesses of ITC. So from that perspective, ITC had announced, and shareholders have been expecting that the capital support that ITC provides to the hotels business be taken in a separate subsidiary or otherwise. I think it would have been possible if it had been a subsidiary, but what ITC has done is more of an associate company with it retaining 40% shareholding. At the end of the day, yes, is there a logic to it? Yes, because at the end of the day, this is something that ITC is undertaking for the first time over a period of time, possibly with it is like baby steps towards total unlocking of the shareholding itself. So from that perspective, there will be continued support or usage of the ITC brand. There is some uncertainty on the fact that what will ITC Hotels give as royalty to ITC itself and what other supports. Obviously, there are common corporate functions. All these would likely be used by ITC Hotels itself, but we expect that it will be positive for the minority shareholders of ITC itself, which is because it's a promoter-less company, all 100% shareholders tend to be benefited from that demerger itself.
Right. Sriram, one thing we want to ask you, it's been a long-awaited ask from ITC shareholders to go ahead and simplify the corporate structure. And this particular move was seen as one step towards that. But the main bone of contention appears to be the 40% holding that ITC will continue to hold as far as the hotel business is concerned. So what is your stand regarding that particular holding of ITC, and going forward, how would you like that to be simplified?
See, obviously the company was hard-pressed to explain this. It possibly could be to ward off any hostile takeover of ITC Hotels itself. Two is it could be to sell off this 40% to a strategic player sometime in future. Three is probably this is the baby steps towards complete disinvestment over a period of time. So there are basically ITC is keeping various possibilities alive by having this 40% shareholding still. So while it doesn't have to consolidate the books of accounts, it would still be sort of getting benefits of the, I would say that 40% shareholding to the accounts from a dividends perspective or whatever. So this is just I would think, a value addition, or possibly there are a lot of hotels in the development, and sometime in the future when they divest this 40%, ITC shareholders itself may benefit enormously.
Right. If I look at the shareholding pattern of ITC, around 25% is held by British American Tobacco. Yeah. You have another 23% by, the government held, 25% by government held entities itself. You have the LIC or the SUTI itself. Do you not think ITC would have consulted these large shareholders before a move like this, and the possibility of them having been on board with this?
I don't think there would have been one-on-one discussions, but as analyst community and investor community has for long sought that ITC should simplify some of its corporate structures, should divest some of these capital, I would say, intensive businesses like the hotels business for sure, and unlock value. So because when ITC stock was trading at 200s and etc., though it was generating a lot of profit, the stock price was not moving. At that time, the ask was much more compelling. I think now at 400s and all, so I think the pressure on the management to unlock value is reduced a lot.
So, fundamentally, if I look at contradictory calls coming in from both InGovern and, IIAS, the eventual belief is the same, but it's just that you think that by this move, the uncertainties will be ironed out in later future. And whereas IIAS wants clarity right now itself. They want, clarity on what the synergy value is, what will happen of that 40% stake, what that royalty is. Case in point, there is no clarity even after this goes by. What do you think should be one's view then?
So I think at the end of the day, see, obviously at each of the analyst calls, the ITC management is under pressure to explain some of these. Two is going forward, how will this 40% pan out? We'll have to see that. Three is obviously ITC Hotels as a listed company with 60% being held by public shareholders obviously could do well on its own, because it could raise capital on its own accounts and books and get debt funding, etc., which is, because it's a capital-intensive company, it can easily raise debt on its books.
And finally, if, for instance, this does not go through, what do you think ITC will have to go back to the drawing board and reconsider this whole plan? What do you think happens next?
Yeah, well, see, obviously, if this doesn't go through, ITC need not necessarily go through the hotel demerger. The hotel demerger itself was asked from its own shareholders, right? I mean, analysts and investors have been asking for demerger of the hotels business. Just that the structure of ITC owning 40% is something that is some commentators and investors were thinking against. But at the end of the day, possibly this is just a baby steps towards full disinvestment.
Thank you so much, Sriram, for joining us and giving us your points and giving us your detailed rationale as to why exactly you're urging investors to go ahead and vote for the proposal of demerging the hotels business. But that's all the time we have on this edition of Midcap Radar. As markets continues to surge near lifetime highs, we will go into a short break. Your stocks when we return.